Financial management, an overview for business studies students studying this area for the first time. There are three main questions that business owners ask when starting or operating their business. Where do I get the money from to expand the business? Will that make a profit? And will I get a return on my investment? Three important questions, and that's really why we're here. We must remember that we must relate everything to the goals that we set in the first place. Maximise profits, increase market share, maximise our growth, improve a share price. There's a nice little graph of share price, that's the way we'd like it to go. And importantly, if we talk about profit maximisation, it's the gap between the total revenue that we have for getting for selling a product or service and trying to minimise the total cost as much as possible. So the total revenue at maximum difference from total cost is what we're trying to achieve. So revenue maximisation and cost minimisation. A graphic example relating to market share and improving a share price is the big battle that goes on between our two big retailers. Please have a look at the YouTube clip, and during the lesson time I'll ask you to complete the snapshot questions on the case study on page 149.
This is Woolworths Limited, and this is Wesfarmers. You know them as Woolies and Coles, the big friendly giants, the number 1 and 2 retailers in Australia. 23 cents of every dollar we spend ends up in their pockets. More than just Woolies and Coles, they own a range of supermarkets. They also own variety stores, electronics outlets and hardware chains, as well as many of the places you buy alcohol. And not just bottle-os, Woolies has a 75% stake in 270 pubs and clubs, and Coles is catching up with 91. That's a lot of poker machines. Woolies alone operate 12,000 of them. The giants also sell fuel through deals with Caltex and Shell, and Wesfarmers owns coal mines in 3 states. But their core business is still groceries. Together, they share more than 70% of the Australian market. The UK's 2 biggest chains share 48%. The US equivalents are mere 20. The giants flex their competitive muscles in a number of ways. They gradually buy out smaller rivals in a process called creeping acquisitions. They also buy land their competitors might be interested in and leave it vacant, a tactic known as greenfield acquisitions. In 2008, an ACCC inquiry found evidence of more than 700 restrictive covenants. Deals made by Woolies and Coles with shopping malls to keep out rivals such as Aldi and IGA. The giants agreed to phase out this anti-competitive practice, but hundreds of the contracts remain. The giants have also been accused of predatory pricing, using their huge buying power to push prices down, driving smaller competitors out of business, at which point they're free to raise prices again. And they don't just squeeze their rivals, they squeeze their suppliers too. The National Farmers Federation claims farmers are getting as little as 5% of what you pay at the checkout. Finance commentator Robert Gottliebsen describes this as one of the greatest scandals ever seen in this country. Despite a recent ACCC inquiry into pricing competition backing the giants, farmers groups are now calling for a royal commission. Last year, Woolies and Wesfarmers made over $100 billion in revenue. They spend millions of that marketing themselves as caring Australians. Yet our grocery prices are up 41% since 2000. That's 8% higher than the OECD average. But if you want to protest by shopping elsewhere, good luck. Woolies and Coles have 6,500 stores. Despite protests from some communities, that number keeps growing. Woolies and Coles, our big friendly giants. As the Coles ads tell us, every dollar counts.
Now that we've seen what the Coles and Woolies situation is all about, let me just relate further objectives of financial management to you. Profitability, increasing profit as much as we can. The growth in our business, so we have an increase in sales, we're obviously going to make hopefully more money. Efficiency relates mainly to how we control our costs. So remember that if we decrease our costs as large as we can, we increase our level of profitability. And these last two are interrelated. Liquidity talks about the amount of cash flowing through a business. So a business is said to be solvent if it's got enough liquidity, i.e. enough cash flowing through the business. More on that later. Before we dive into the accounting and finance sections, let me remind you that there's 4 business functions and they're all interrelated. Finance is the core component, but they are also dependent on how well the operations go, how well we market our product or service, and what people we have employed. So there's this interdependence with other business functions which we need not to forget. Okay, financial management has 2 main arms, finance and accounting. Let's start with finance. That was related to one of the first questions we asked, where are we going to get the money from to source its funding? So managers need to ensure that the business has a good credit rating so that banks will lend the business money. A credit rating is developed over a period of time by paying back loans quickly and efficiently. The business may want to expand, update technology, or open overseas. All that takes extra money. Where to get that money from is a big question. Usually the banks is that source. The other source can be the shareholders or other owners that come into partnership into our business. But if we don't have that much money, it's the banks we go to, and they want to assess the ability for the business to repay the loan. So if their business goes bankrupt, they want to know if they can recoup that money through various other assets they can sell. And also, can they manage their finances so they can make repayments on a weekly or monthly basis? So they're the 2 main things the banks looks at in relation to finance. So in relation to finance, it's to do with how the business funds its activities to expand or whatever, how they manage their borrowings over the period of time which they've made the expansion, and also they plan for future expansion. So they need to have a 3 to 5 year strategic plan, and for that to occur they must plan over that period of time to make these things come possible. Now the other side of financial management is accounting. Essentially is to provide financial information about the business. What sort of things do we need to know about? Well, they need to know about cash flow. We've mentioned that already. They need to anticipate when cash expenditures are due and ensure that enough money or income has been generated in the meantime in order to make a profit. And there's always something unforeseen that comes up, and we need to have enough cash there for unforeseen expenses. The study of accounting is to do with the recording of financial transactions, and examples are cheque payments, so we pay for our wages, we receive money from our customers, we issue invoices to our customers, we receive dockets, delivery dockets from our suppliers, and as the world goes on these days, more and more transactions are made electronically. Now all these transactions are summarised and posted into accounts onto a computer. So we will know how many sales we've made and what our cash bank balance is, how much our suppliers are owed and so forth. So all that needs to be put in account. Now we're not concerned with that. We're more concerned about the financial reports. So once they're summarised, the final account balances are posted to financial reports for us to use. We're the managers, remember? And once we've got those reports, we interpret those to run the business and to manage it, and to try and keep the business on achieving its goals and maintaining its viability to remain solvent and so on. There's 3 types of reports that accountants look at or generate. We only have to use them and interpret them. Right? So the cash flow statement looks at the liquidity, i.e. the amount of cash going through a business. Income statements is involved with looking at the income and its expenses to try and generate as much profit as possible. And the balance sheet, it's to do with the financial stability of the business in terms of what it owes, their liabilities, in terms of what it owns, its assets. More on that later. A range of stakeholders are interested into what happens within the firm. First of all, the competitors, they are hungry after its customers and so forth, and will do anything to try and gain sales from us, the business. The government, well, they're interested in us paying taxes and so forth. The customers, they want good value and good products and services. The lenders, providing the finance, they want to ensure that they get the money back and make that we make regular payments to them in terms of interest and paying back the capital. Suppliers, well, they rely on us very heavily to supply us with the goods that we need in order to satisfy our customers and our shareholders. And lastly, the general public, where you can put the shareholders in that lot. So there's a number of people or stakeholders that rely on us. Accounting is useful to provide information to state what our financial position is, what our cash flow position is, what our financing position is, and our capability to keep paying our debts or to indeed expand our debts, what our profitability is, and what our return on investment is. And you notice that these all relate to the initial aims and objectives of financial management in the first place. We also want to analyse trends in terms of all these things here, so we can manage our business the best way possible. Now I want you to stop here for a second, go to your books on page 235, and these questions I want you to do before you go on to the next section, please.